Houston, we have a tax problem. The law has always had a problem with altitude. Here on Earth, we draw neat lines on a map and call them borders. We assign those lines to taxing authorities and know who collects what. The higher you go, the fuzzier things get. Airspace law is like a neighborhood feud about where the fence belongs, except the fence is somewhere above the clouds. If we cannot agree who controls the sky, how do we decide who gets to tax outer space? That is the question in University of Florida, Professor Erica Isabella Scuderi's upcoming Nebraska Law Review article titled On Sovereignty, Outer Space, and Taxation. Airspace rules evolved for airplanes, drones, and satellites. Beyond the atmosphere, where gravity is more of a suggestion than a rule, sovereignty gets slippery. Treaties mostly keep nuclear weapons and nuclear waste out of space. Taxes are barely on the radar. The stakes are enormous. The space economy is real. Private companies launch constellations of satellites, beam internet around the globe, map Earth in high definition, and even plan to mine asteroids. There is money to be made, and tax authorities will want a piece. But whose piece? The country where a satellite is built, the country that controls it, or the place where the signals are received? Some imagine a future space tax authority planting a flag on that revenue stream. If that sounds far-fetched, remember that Star Wars opens with a blockade over trade tariffs. Laws change fast when money is at stake. In space, we are building the economy first and writing the rules after. It is like mining an asteroid before asking a smart assistant if that is Grand Theft Space Rock. Waiting for lawsuits would be a mistake. Today's rules are grounded in geography. Tax laws are written for earthbound activity, where someone can point to a patch of dirt and say, "This is ours." In space, there is no dirt, no fence, and no deed. Without a framework that anticipates commerce, we invite chaos. If multinational companies in the top 1% can hide income in places like Ireland or the Cayman Islands, imagine what could be stashed in orbit. Picture one fight. A company mines an asteroid, processes metals in an orbital plant, and sells to a buyer on Earth. Which nation claims the revenue? The launcher, the controller, or the place where the shipment lands? Without agreed rules, every launch carries an extra payload of litigation. It is fun to imagine the Internal Revenue Service explaining how to depreciate a lunar colony or whether hyperdrive fuel is deductible. The point is serious. As the space economy accelerates, tax collectors cannot keep their feet on the ground. To avoid competing claims in interplanetary tax havens, rules should be drafted now, before the first lunar initial public offering and the question of whether zero gravity applies to withholding rates. Until those rules exist, stay grounded on Earth. Map where income is earned, where work is managed, and where assets sit. Scan for incentives available today, such as energy credits and accelerated depreciation. Keep a light file for major moves that shows who, what, when, and why. David Tuck is a real estate tax advisor and a former Internal Revenue Service auditor. He helps investors apply that grounded process so they keep more legally while the law catches up to the sky.